BlackRock. $2.4 billion in BUIDL. That is the number that tells you tokenization is not a concept anymore. BlackRock's USD Institutional Digital Liquidity Fund has grown to $2.4 billion in assets under management by Q 2026. In May 2026, BlackRock filed with the SEC for 2 additional tokenized funds on top of that, plus on-chain shares for a $7 billion money market fund, the largest asset manager in the world. Managing over $10 trillion in traditional finance is not experimenting with tokenization. It is accelerating it. And the total real-world asset tokenization market driven by BlackRock, JP Morgan, Franklin Templeton, Fidelity, and others has now crossed $32 billion in 2026, up more than 200% in a single year. So here's the question that every XLM holder needs to answer honestly. If BlackRock is the engine driving a $32 billion and growing tokenization market, and XLM holds 13% of that market, second only to Ethereum's 56%. What is XLM actually doing, actually worth, when that market reaches 100 billion or 200 billion or a trillion? Not math. Real supply numbers, real market share data, real scenario pricing, and the one counter argument you need to understand before you can hold the bull case with confidence rather than just faith. That is what this video is. Let me start with what XLM's 13% actually means in the context of BlackRock's expansion strategy, because most XLM holders have never had this framed clearly. BUIDL launched on Ethereum in March 2024. By 2026, it has expanded to 6 blockchains. Stellar is one of those 6. That is not a rumor. That is sourced from the Luminex network analysis from June 3rd, 2026, and the DEX Tools Institutional Guide published in late June. BlackRock has explicitly not committed to a single chain. Martin Small, BlackRock's head of ETFs and index investments, described their approach as a multi-chain strategy playing out over a 90-day to 12-month window, framing tokenization as a multi-year infrastructure shift. What that means for Stellar is specific and important. Stellar is not competing to be the only chain that holds BlackRock tokenized assets. It is competing to be one of the chains that institutional tokenization lands on, and it is already in that position. 13% of a $32 billion market is $4.16 billion of tokenized assets on or connected to Stellar's network right now. Before we continue, if you enjoy this type of content, don't forget to subscribe to my channel. And if you're interested in joining my GCRIG arbitrage trading team, leave a comment on this video or send me a direct message on Telegram at XRPTaubert. That's my username on Telegram. Now, let's get back to the topic. The 6-chain expansion of BUIDL matters for a specific reason that most analysis skips. BlackRock does not expand to a new chain casually. The legal structure of BUIDL, a regulated SEC qualified investment product, requires that every chain it expands to undergoes compliance review, legal sign-off, custody partner verification, and operational validation before BlackRock's name goes on it. The compliance process for adding a new chain to BUIDL is not a technical exercise. It is a full legal and regulatory review. Stellar passing that review means BlackRock's legal and compliance team looked at Stellar's architecture, the clawback functionality, the transfer restriction controls, the identity management capabilities, the KYC enforcement mechanisms built into the protocol, and concluded that Stellar meets the standards required to hold a BlackRock branded regulated investment product. That is a level of institutional due diligence that most blockchains have never had applied to them. The ones that have passed it are in a small and specific club. Stellar is in that club, and the 13% RWA market share trajectory tells a story when you look at the growth rate rather than just the snapshot. Stellar's RWA market cap grew 3 times over in the past year alone, according to the Luminex June 3rd analysis. The broader RWA market crossed $32 billion in 2026, up over 200% from under $10 billion a year prior. If Stellar maintains 13% of a growing market through the DTCC integration and the BlackRock BUIDL multi-chain expansion, what does 13% of $100 billion look like? $13 billion of tokenized assets on Stellar's network. $13 billion generating account creation, trust line requirements, fee transactions, and reserve lockups on a fixed supply of 30 billion circulating XLM. The market has not priced that scenario. It is pricing the $32 billion current state. The gap between today's state and a $100 billion market is the gap where the price re-rating lives. Now, the DTCC layer, because this is where Stellar's position becomes structurally different from every other chain in BlackRock's multi-chain expansion. In May 2026, the DTCC, the institution that clears and settles the overwhelming majority of U.S. securities, announced it would connect its tokenization platform to Stellar as its first public blockchain. DTCC custodies $114 trillion. It processes $4.7 quadrillion in securities transactions annually, and it chose Stellar, not Ethereum, which has 56% of the RWA market, not any of the other chains in BlackRock's multi-chain expansion. Stellar, as the first public blockchain connected to the system that every major financial institution in the United States, including BlackRock, uses to settle its securities, the production phase of that integration started in July 2026, right? Now, limited participants, real assets, real settlements. October 2026 brings the expansion to more participants. The first half, 2027, full deployment follows, and the mechanism by which those settlements generate value that flows to XLM is the thing that most analysis, including the best bear case analysis, either gets wrong or underweights. So let me state it precisely. Here is the counter argument, and I want to give it to you as clearly and as fairly as the people making it have stated it. A.Invest published this on May 28, 2026. The argument is this. BlackRock charges management fees on BUIDL. BlackRock earns the spread. BlackRock owns the relationship with the end investor. FIS reported over $800 million in signed tokenization contracts as of Q1 2026. FIS is not sharing that revenue with XLM holders. The DTCC captures custody fees and settlement fees from its institutional clients. DTCC does not pay XLM. Stellar provides the rails. Rails are free to use. XLM is the toll. But the toll per transaction is fractions of a cent. How much value actually reaches XLM holders from trillions of dollars flowing through a network, charging fractions of a cent per transaction? The A.Invest conclusion was that XLM's rally on the DTCC news was a narrative reflex, not a cash flow justification. That is the best version of the bear case. It deserves the best version of the answer. The fee per transaction being fractions of a cent is not the thing that matters for XLM's value. The fee argument is the wrong frame. The right frame is minimum balance requirements times account creation times fixed. Supply, every account on the Stellar network, must maintain a minimum balance of 1 XLM as a base reserve. Every additional asset that account holds requires an additional 0.5 XLM as a trust line reserve. These are not fees. They are structural requirements that exist for as long as the account exists. They are XLM that cannot be sold, cannot be traded, cannot be lent, permanently locked in the account as the cost of it, existing on the network. Now, apply that to what happens when the DTCC integration scales through October 2026 and into 2027. A medium-sized asset manager connects to the DTCC's tokenized securities platform. It creates wallets for 500 institutional clients. Each account holds 10 different tokenized securities: U.S. Treasuries, Russell 1000 stocks, ETFs, government bonds. That's 1 XLM base reserve plus 5 XLM in trust lines, 6 XLM per account. 500 accounts times 6 XLM is 3,000 XLM permanently locked from a single mid-sized manager, scale to 1,000 institutional participants, each with 200 client accounts, each holding 15 tokenized assets. That's 1 XLM plus 7.5 XLM equals 8.5 XLM per account. 200 accounts per participant times 1,000 participants times 8.5 XLM equals 1.7 million XLM permanently locked in reserve requirements before a single fee-generating transaction occurs. 1.7 million XLM out of 30 billion circulating is small, but the DTCC's institutional network is not 1,000 participants. It is the backbone of U.S. security settlement, serving virtually every major financial institution in the country. As the tokenization platform scales, as more of BlackRock's expanding product suite, more of JP Morgan's tokenized assets, more of the $32 billion in growing RWA market routes through DTCC-connected stellar infrastructure, the reserve lockup grows with every account created on a fixed supply that cannot be inflated away, on a supply where 50 billion total tokens were permanently fixed in November 2019 when the SDF burned over 50 billion XLM and removed the inflation mechanism forever. And BlackRock's trajectory in 2026 makes the direction of this account creation curve clear. BUIDL at $2.4 billion. 2 new fund filings in May, on-chain shares for a $7 billion money market fund. BlackRock is not slowing down its tokenization expansion. It is accelerating it. And the DTCC infrastructure, which BlackRock has used for decades, is the settlement layer that BlackRock's tokenized products ultimately clear through. Every new BlackRock tokenized product that comes to market, every new institution that connects to the DTCC's tokenized securities platform, every new account created in that ecosystem on Stellar, that is more XLM locked in reserve requirements on a fixed supply. The MEXA analysis published 1 week ago framed the year-end 2026 forecast range. Honestly, bearish end is approximately 18 cents, essentially flat from today. Bullish models range from $1.20 to $2.50. The gap between those scenarios turns on exactly one question: whether the account creation and reserve lockup mechanism translates into sustained open market XLM demand as institutional participation scales, or whether institutions acquire the minimum XLM required through ecosystem grants and subsidized channels that never touch the open market. That question does not have a definitive answer yet, but the October 2026 expansion phase, when the DTCC opens its tokenized securities platform to more participants, is the first real test. If the net exchange flow for XLM turns consistently negative in Q4 2026, If XLM is flowing unnoticed off exchanges into institutional custody wallets at a rate that exceeds selling pressure, that is the on-chain signal that open market demand from institutional account creation is operating. If exchange reserves stay flat, the mechanism is not generating the demand the bull case requires. Now, the money framework, you actually need to hold this thesis properly, not the fee income math, the unrealized appreciation calculation, because XLM does not pay yield, but a fixed supply asset with growing structural demand produces a mathematical equivalent to yield that most holders have never calculated. If you believe the reserve requirement and institutional adoption thesis plays out over 24 months and XLM reaches $1.50, requiring a market cap of approximately $45 billion, here is what different position sizes produce. 10,000 XLM at today's price of approximately 19 cents costs $1,900. At $1.50, 10,000 XLM is worth $15,000. A gain of $13,100 over 24 months divided by 24 months is $546 per month in unrealized appreciation from an under $2,000 investment. To reach $1,000 per month in unrealized appreciation at the $1.50 scenario over 24 months, you need approximately 18,300 XLM at 19 cents. That costs $3,477 at the bullish $2.50 scenario, requiring a market cap of approximately $75 billion below Ethereum's current market cap. 10,000 XLM becomes $25,000. A gain of $23,100 over 24 months is $962 per month. $1,000 per month at $2.50 requires approximately 10,400 XLM, a cost of $1,976 at today's price. The conservative $1 scenario, requiring a $30 billion market cap, comparable to XLM's previous cycle peak, produces a gain of $8,100 from 10,000 XLM over 24 months, or $337 per month. $1,000 per month at $1 over 24 months requires approximately 29,600 XLM, a cost of $5,624 at today's price. Between $2,000 and $6,000 of XLM purchased today generates $1,000 per month in unrealized appreciation across the realistic scenario range if the thesis plays out on a 2-year timeline. That is the practical sizing framework, not a price prediction. The math of what your position produces at each scenario given your specific holding. Now, the Stellar-specific moat that makes BlackRock's multi-chain strategy more likely to deepen on Stellar rather than replace it over time. The DTCC relationship stretches back nearly a decade through SEC currency, now DTCC digital assets. Compliance tools, clawbacks, transfer restrictions, identity controls were built directly into Stellar's protocol layer because institutional use cases demanded them. Franklin Templeton explored Stellar in 2019 and launched Benji in 2021. One of the earliest regulated tokenized funds on any public blockchain, Benji became the proof of concept that grew the tokenized treasury market to $15 billion, with BlackRock, JP Morgan, and Fidelity now competing in the space. That decade of embedded compliance architecture is not a business decision that BlackRock or the DTCC can reverse with a different business decision. It is infrastructure that was built into the protocol because institutional requirements demanded it, and it's the specific reason the DTCC chose Stellar as its first public blockchain rather than any of the other chains it could have chosen. Let me be specific about what Benji's track record actually proves, because it is the evidence base that underwrites everything else in this script. Franklin Templeton ran a regulated money market fund on Stellar from 2021 to 2026. 5 years, $750 million in assets under management at its peak. 5 years of live institutional deployment at scale with no security incident, no settlement failure, no compliance breach on the network side for an institution evaluating whether Stellar can handle their institutional tokenized product. 5 years of Benji data is not a white paper. It is an audited operational history. BlackRock's compliance team, when it evaluated Stellar for BUIDL's multi-chain expansion, did not have to rely on theoretical capabilities or test environment performance. It had Benji's 5-year history as evidence that Stellar's compliance architecture works under real institutional conditions. And CoinDesk's reporting from May 31st, 2026 confirmed that Dixon specifically cited Benji's record-keeping approach, using the blockchain as the official record of fund ownership rather than a secondary system of record. As one of the key demonstrations that led to the DTCC choosing Stellar, that decision chain, Franklin Templeton's 2019 exploration, Benji's 2021 launch, 5 years of live operational history, DTCC's May 2026 announcement, BlackRock's BUIDL multi-chain expansion to Stellar, July 2026 production phase, is not a series of disconnected events. It is a single compounding institutional confidence narrative that has been building for 6 years and now is reaching the phase where the production infrastructure goes live. The people who bought XLM in 2019 when Franklin Templeton was quietly exploring Stellar held through 6 years of building before the DTCC announcement arrived. The people buying now, with the DTCC production phase already running, are buying at the point where 6 years of foundation are visible and the next phase of scaling is the known timeline. Rather than the speculative possibility, Stellar is second in the RWA race at 13%. BlackRock is the dominant force driving that race forward. The DTCC is the infrastructure that connects BlackRock's tokenized products to the institutional market. And Stellar is the first public blockchain the DTCC chose to connect to its tokenization platform. Those three threads are the BlackRock XLM connection that the title of this video is about. Not a direct partnership, a structural position at the intersection of the most powerful forces in institutional tokenization. The production phase is live. The October expansion is coming. The first half 2027 full deployment follows. Drop in the comments at which of those three milestones do you think the open market XLM demand signal becomes visible enough that the $1.50 scenario starts looking like a base case rather than a bull case? Because that's the specific question this community is best positioned to answer. If this gave you the BlackRock to XLM connection with the math behind it, rather than just the vibes behind it, hit the like button. It's the difference between holding something because it sounds right and holding something because the numbers support it. Subscribe if you want the October 2026 update when the expansion phase data arrives. And share this with whoever in your life is asking whether BlackRock tokenization going live is actually good for XLM. Because the answer is yes. And now you can explain exactly why BlackRock is driving the market. Stellar holds 13% of it. The DTCC is the infrastructure that connects them. The math is on the table. Have a great day. If you enjoyed this video, don't forget to like, subscribe to the channel, and be sure to join my free Telegram community with the link on my channel where I post my daily crypto experience and arbitrage opportunities you can't get anywhere else. This is XRP Hobart signing off.